The nation's most popular investment talk show is Mad Money.
Big fan of the show.
It's one guy talking stocks, droning on and on.
I'm as mad as hell, and I'm not going to take this anymore.
And it should make you mad, as in angry or crazy, because you need to hear from a variety of market sources.
Of course, the more the merrier.
You need to get a wide range of ideas. You need some balance. And you need to hear something different just to stay excited about investing in these wild times. This is MoneyLife Market Call. Different experts every day talking stocks, funds, and more.
You had me at hello, tier.
With experts telling you not just what they're buying and selling, but why. Who cares if it's not the most popular show?
Maybe you didn't have any friends.
It won't make you mad.
This is an outrage.
It will make you smart.
Yes, it will. Welcome to the MoneyLife Market Call, where we hope you're going to get smarter today by listening to Charles Mizrahi. He is the editor at Park Avenue Investment Club. Now, if you've heard of him here before, well, you know that he was the editor at Hidden Values Alert and Inevitable Wealth Portfolio. And there have been some changes at his shop. They have affiliated with new folks, and the result is a rebranding. Now, that means that you're getting new things, but it's the same basic system that Charles has been running. And so if you liked what you heard from him before as a dedicated value investor, well, then you're going to like what you hear from him now. If you want more information, parkavenueinvestmentclub.com. Charles Mizrahi, welcome back to Money Life.
Thank you, Chuck. Great to be back.
Charles, we always start with methodology because it never makes sense to give buy, sell, or hold before we know exactly what goes into it, and explain to folks a little bit why the change to Park Avenue Investment Club and how it does or doesn't change anything in the methodology.
Well, Chuck, in terms of methodology, nothing changes. Our methodology is still the same. We basically look to buy dollar bills for 50 cents. We don't want to pay for future earnings. We don't want to pay for future sales. We don't want to pay for any type of hype. We want to pay for what the company has done and what it's worth today. Any growth, any surprises will hopefully be good ones, which will up the price and give us more value. So we changed the name because it more or less reflects what we've been doing, and what I've been doing for the past 30 plus years on Wall Street is basically being an insider in a sense. I was a floor trader, money manager, ran a hedge fund. I have extensive contacts on the street, a lot of analysts that are personal friends of mine, and we swap a lot of good ideas. And we thought the name Park Avenue Investment Club really signifies more of what we're trying to do, is create a membership of like-minded people where we can give selections that are off the beaten track and that most people are not following, and that's where we get the most bang for the buck.
So in this market where we're at near or at record highs, and people are talking about valuations, are you finding a lot of dollars on sale for 50 cents?
No. The higher the market rises, the less sales you'll have. And when markets fall, the more stocks go on sale. So it's not impossible to find, but they're not as easy to find. And the reason is because average companies, mediocre companies are being bid up to a high level of valuation. So it just becomes a lot harder to do what we do, but there's still value in certain pockets of the marketplace. And that's what we're constantly doing. Our team is constantly looking over companies and seeing where Mr. Market messes up on the pricing. And just keep in mind that 80% of the time, the market is efficient. It prices stocks according to more or less what the actual value of the company is. It's that 10 to 20% of the time during extreme euphoria and extreme gloom where the market is going to misprice. And those are your best opportunities.
So if that's correct, we're at this peak. Do you think we're getting to a period where either you have extreme optimism or you have that? I mean, we're also getting a fair number of doomsayers saying, come on, it's got to crash. It's got to have something bad happen. Are we getting to a period where the value is going to come out?
Well, first of all, we don't listen to any doomsayers or any market cheerers or leaders. We basically focus on the companies the same way you'd buy a hardware store or a coffee shop or a bricklaying company in your hometown. You look at the numbers, you look at the business, and you see you're getting more value than you're paying. That's basically it. And what we're doing is we're going company by company. We're not top down, we're bottom up. We look at certain areas of the marketplace for mispricing. For example, the market over the past several months has been kicking the heck out of retailers of all shapes and sizes due to Amazon's globalization and dominance of the retail world. Now, many retail businesses shouldn't be in business because Amazon will eventually knock them out or have already killed them. So what we're doing is finding companies, certain businesses that are still doing well in the age of Amazon, that Mr. Market has mispriced greatly, because when the market likes to get depressed, it throws out the baby with the bathwater. And now that we're trading in such large volume and such large dollar amounts, ETFs, which basically package retail companies and package financials, and you could buy a whole sector with just buying one stock, they don't really care what's in them. If they hate retailers, they're going to sell and bang that whole basket of retail stocks. So that's where you're going to find the great values. Will there be more in the future? Absolutely. When? I have no idea.
So what makes you sell in this market? If you bought your dollar for 50 cents and you're able to ride it up and the tide of the market is riding higher, do you sell when it gets to be $1? Do you sell? I mean, what's changing about the sell metric, if anything?
Well, nothing really. There are two ways you want to sell. And this is what just boggles my mind, how investors never even look at this or think this through. They basically sell when things are down and they buy when things are going up. And that's the exact opposite of what they should be doing. And what they probably do in their own life, in their own business. They don't go buy a house and, oh, wow, I'm so excited. The house is now valued at $800,000. Yesterday was $700,000. So I'm going to make sure to buy today and keep buying higher. The thing that we're looking at basically is this. When a company is trading for a dollar bill, and we value it at a dollar bill, for example, we value it at $10 a share, and the company's trading for $10 a share, there's not much upside there. It's trading for basically what it's worth. If the stock would go up to $15 and the valuation would be $10, we start to look to get out. If the valuation becomes gross, in terms of, let's say it's a $2 bill trading for a dollar bill, we'd want to sell. The next thing we look at is, if we're going to sell, do we have something cheaper to buy? So those are the two things we look at. We're always trying to sell cheap and buy cheaper, and we're always trying to make sure that the valuations that we have are not way out of proportion to the value of the company.
So let's talk about a name or two that is kind of the poster child for what you like to be buying and what maybe still is worth buying right now.
Well, one good company that we've owned for a while, and we just recently recommended again, was Huntington Ingalls, symbol HII. And Huntington Ingalls is a rather interesting company. We added them to our portfolio about 2012 or so, when they were just spun off of Northrop Grumman. And the company is a shipbuilder. They're the largest shipbuilder in the United States. In fact, they really have no competition. They're the ones that build the aircraft carriers and nuclear subs for the U.S. Navy. So this is a company with a huge amount of backlog. And in fact, the aircraft carrier, the Gerald Ford, they just released that. They just launched that a few months ago. They're the company that not only builds these ships, but also services them. We've owned it in our portfolio since September 2012. We're up 460% on it as we speak. We recently added it again to our portfolio, recommended it to the portfolio in June at about $185 a share. The reason being is we saw that as it was undervalued based on what the worth of the company is. You couldn't replicate this company. And it was trading at a real attractive valuation, especially in this market. So far, it's up to $215 a share, up about 15 or 16% since we bought it. But that's an example of finding a great company and waiting for it to go back on sale and adding to it. Another company that we recently added to one of our other portfolios was TJX. I shouldn't say recently added. We've owned that for a while. TJX is a good example of a company go against the tide. Amazon has been killing retailers.
Mm-hmm.
TJX has been holding their own and continues to grow. And the reason is because when a TJX shopper goes to the stores, TJ Maxx or Marshalls, for example, the experience of finding in the hunt is what they're going for. They're not going for clicking and getting it 2 days later. The prices are great. The environment that TJX creates for its customer is fantastic. They've had rising sales over the last several years. We're up 283% on them, and the stock continues to do well. Now, one other company that we recently added to one of our other portfolios happens to be in retailing, and that is American Eagle Outfitters, symbol AEO. Now, that's a company we think has been severely kicked in the gut by Mr. Market. The company has a strong balance sheet, was trading at a low valuation, and people still shop at American Eagle Outfitters. So we're getting paid a premium, in a sense, to buy and hold this stock because we feel that the business is worth way more than the $11 share price that it's trading at now.
Now we're going to find out how you feel about some stocks that my audience is particularly interested in.
Hold it.
You got to know when to hold up.
Or fold it.
Know when to fold up.
Yes, it's Hold It or Fold It time with my guest, Charles Mizrahi, the editor at ParkAvenueInvestmentClub.com. That's all you need to do. By the way, he's on Twitter at IWP because he set up his Twitter when he was running Inevitable Wealth Portfolio. That's what the IWP stands for. You know how Hold It or Fold It works, so we're just going to jump straight in, starting with a request we got from Dave in Beaver Dams, New York for Google or Alphabet, ticker symbol GOOG.
Google, Alphabet, whatever you like to call it now, really Alphabet is the name of the company now, is a company which is one of the very few that Warren Buffett said at the annual meeting. He was wrong on it. He didn't pull the trigger. What he was wrong on was the ability for Google to generate money, to generate income, to generate cash flow without spending a lot of its own money. This is a business that doesn't need capital to run. It generates its own. Google is the dominant player in search, 80% market share globally, over 90% in mobile and tablet, 80% in desktop. Microsoft threw everything it had at it with its search engine Bing, barely got 7% market share. Alphabet is coming out with a wide array of products and services, and one thing that you could definitely say for sure is that they're going to constantly innovate, and their growth potential is huge. So even at these price levels, we think GOOG or Alphabet is a great long-term buy.
Winner, winner, chicken dinner.
That's a buy, a strong buy on Alphabet, GOOG. Donald in San Mateo, California wants to know about Oracle Corporation, ORCL.
Yeah, Oracle Corporation, one thing which got us very interested in this some time ago was that we were looking at 13F filings. Those are filed by hedge funds and money management firms who have more than $100 million in assets. And you get to see who's buying what. And we saw recently in the last year or so, many smart investors start to buy Oracle. And then we started doing further research. Oracle's a tech giant, $200 billion market cap. Their cloud business is 12.5% of revenue and growing. Their software as a service and the platform were up 58% over the past year. Net profit margins have been stable. Revenue is creeping up. They have $66 billion, mostly in cash overseas. And if the new administration has a change, which it looks like in terms of taxation of money coming overseas, this could be a huge win for shareholders. And we think Oracle's trading at a very attractive valuation for long-term holders.
Let's make some money.
That's a buy on Oracle, ticker symbol ORCL. Joe in Colorado Springs, Colorado wants to know about XPO Logistics, ticker XPO.
XPO is a great company. We've been following Brad Jacobs for a while, who's a CEO. This guy is a serial entrepreneur. He built United Waste into the 5th largest solid waste management business in North America. He built United Rentals into the world's largest equipment rental company. And 5 or 6 years ago, we started XPO Logistics. The his main focus was that this was a fragmented business, transportation and logistics, getting things from point A to point B. And he started to consolidate that business. Already the company is doing close to $15 billion in only 6 years in revenue, $15 billion. They're the number 2 contract logistics provider worldwide and the number 2 freight brokerage firm worldwide. So in a very short span of time, XPO has zoomed to the top under great leadership, and this is a case of bet on the jockey, not on the horse. And we're pretty confident in Brad Jacobs at the helm, and we like XPO.
Either gets on board or he gets left behind.
That's a buy on XPO, which is XPO Logistics. Peter in Greenville, South Carolina wants to know about American Outdoor Brands Corporation. Its ticker is its initials, AOBC.
AOBC, American Outboard Brands Corp, is really just a rebranding or renaming of Smith & Wesson, famous gun company. It's been around for over 150 years. Great brand. It's the number 1 brand in firearms. The company has a strong balance sheet. It's trading at only 8.5 times previous 12 months earnings, which is pretty low valuation for a company with a solid brand. The company executes and does well. Political climates change about gun control and so on and so forth. But over time, this is a company with great fundamentals and should continue to produce great returns for shareholders, especially at the valuation that's trading at now.
What Charles Mizrahi just said was take your shot on American Outdoor Brands Corporation, AOBC. And last, for Andrew in San Jose, California, it's BlackRock, ticker symbol BLK. BlackRock,
started by Larry Fink several years back, is one of the largest money managers in the world, $5.7 trillion worth of assets worldwide. The trend in money management now for investors has been going from active management, where your managers are paid a large fee to buy and sell for you, to passive, which is basically buying index fund and ETFs. The problem that we see is this is a secular change in this industry. Fees are lower, but they're gathering more assets. But eventually there's going to be a limit to how much assets they can gather. Active management is under threat, which is still a large part of BlackRock's revenue stream. And money management, which used to be a great, stable, free cash flow generating business, is becoming a much, much tougher business. The company's trading currently at about 21 times trailing earnings. And at this height, we wouldn't want to sell it, but we definitely would hold it and not be a buyer.
Oh. It is too high to be a buy, but it is not bad enough to be a sell.
No money changes hands today.
No money changes hands. That's a hold on BlackRock, BLK. But everything else was a buy, which is remarkable given that Charles said it's a little tough to find buys right now. It's also a little tough to find guests like Charles Mizrahi. Charles, thanks so much for doing this. I look forward to chatting with you again.
Likewise. Thanks, Chuck.
Charles Mizrahi, everybody. He is editor at ParkAvenueInvestmentClub.com. That's the website. Just go check it out. On Twitter at IWP Editor. All right, we're just about done with the Tuesday, August 15th edition of MoneyLife, but just about means not quite. We'll cross the finish line together, tell you where others have agreed or disagreed with Charles on a couple of those stocks and more, and then we'll send you home. Stay tuned.